The financial crash of 2008 left many see their savings, pension funds, and investments reduced to very little in a matter of days.
A warning from the IMF that the global economy was facing its most dangerous crisis for 70 years and that the UK is likely to slip into a recession. The UK's biggest banks are rescued by the British taxpayer, the world's central banks act together to slash interest rates, and yet the International Monetary Fund warns we're facing a major economic downturn. The Prime Minister and the Chancellor making it clear that the financial system is so important to our society that by saving our banks, we're saving ourselves. And so billions of pounds of public money is moving from government downriver to the city. Now, in normal times, money should flow like water between banks and trickle down to companies and the likes of you and I. But these are not normal times. Banks have stopped lending to each other, confidence is in tatters, and credit is drying up. And that situation is affecting both the economy and the housing market.
The time was ripe for a new, non-governmental, non-centrally controlled currency. It was only a matter of time till someone harnessed the virtually limitless connectivity of the internet to bring about a possible alternative. In 2009, the most famous cryptocurrency was born, called Bitcoin. Bitcoin is a digital currency that lives solely on the internet. Bitcoin has emerged from two different technologies: mining, a large network of programmers or miners running long, time-consuming mathematical algorithms on their computers. If their algorithm is successful and validated, which is a random process, their code is awarded the Bitcoin status. And the blockchain, a fully transparent open-source accounting ledger. The blockchain strings together each transaction block, with each new transaction being added to the existing chain, with the identity of the buyers and sellers fully encrypted. The blockchain ledger code is visible to everyone at all times. Tax authorities have typically struggled to get to grips with and classify new financial innovations like Bitcoin. If Bitcoin was categorized as a genuine currency, the gains Bitcoin traders would make would also be considered gambling profits and hence be outside of any income tax. This obviously will see the tax authorities lose millions in lost revenue. However, some are arguing that Bitcoin carries the hallmarks of a commodity or asset similar to stocks and shares. If Bitcoin was to be classified as an asset, the gains the Bitcoin investors have made would be classified as capital gains. The profits made from trading Bitcoins would be subject to capital gains tax at 20% and reported in their tax returns. The tax treatment of the profit made from Bitcoins would depend on the tax classification Bitcoin eventually adopts, i.e. a currency, an asset, or even both. Japan, for example, as of last July, has taken the steps to fully recognize cryptocurrency as a genuine currency and payment method nationwide.
Japan is setting out on a different path, embracing the crypto movement.
Bitcoin trade here in Japan accounts for nearly half the global trade volume. Compare that to 25% in the US. The number has surged since the government passed a new law earlier this year recognizing the digital currency as a legal form of payment.
That law encouraged some big retailers here to partner with Bitcoin exchanges and begin accepting the digital currency. There's already more than 4,500 stores that let you pay with Bitcoin here, and the Nikkei says that number could increase five-fold by the end of the year.
To further promote Bitcoin's national acceptance, Japanese tax laws have labeled Bitcoin as exempt from consumption tax, which is the VAT equivalent of the UK.